I failed at trading until I understood this one simple concept. Now guys, so you can basically think of liquidity as previous orders in the market. So for example, if price is in a bullish trend, we know that there's going to be liquidity or previous orders resting below the previous lows. So in this case, notice how price sweeps that previous low and then heads over to the upside. And this is exactly how we're going to be incorporating liquidity into our trading. So in a bullish market, what I'll typically do is identify any areas of previous liquidity where price could gravitate back towards before then continuing the move over to the upside. So for example, here we can see we have this area of previous liquidity on the 4 hour, and watch what price does once it comes down into that level. It starts to reject and push back up towards the opposing liquidity at these previous highs, right? So this is when we could typically go down to the lower time frames and we can look to get our entry. And this is a very accurate way of entering the market. So notice how once this liquidity to the left is swept, on the 5-minute chart, for instance, we go from this downtrending structure into this bullish structure when price created a higher high here, or as you guys might know it, a change of character. So all I simply look for after the change of character is for price to pull back into an area of demand, and then I would look to buy from this area. Again, considering lower time frame liquidity. For example, here we have previous orders resting below this low. It's a previous area where people were buying from. So before looking to enter, we look for those people to get taken out of the market, and then we buy up to target some previous highs